really it is your exporters and your producers that are trying to take the strain, or are taking the strain, and we need to understand what is holding them back. And we're going to spend a little bit of time on that. The first thing we're going to look at is we're going to look at two global factors that are likely to impact on this economy. And of course, global factors will always have a more significant impact on those who export than those who don't. But indirectly, they do filter through to the consumer, and we're going to show you how. Okay, so let's first deal with the global environment. The irony of where we find ourselves, we shrunk in the first quarter, we've had a weak second quarter, we've had a weak July, and we're now hoping that we can stage a recovery from August onwards. But the irony is that for the first time really in 2014, the world economy has become supportive. We've had a very unsupportive world economy up until around 2013. That was weak and patchy, and only certain parts were growing and other parts were struggling to gain momentum. But it was very clear late 2013 onwards that the world economy was actually on the mend. It was starting to gain some momentum. From April onwards, we have seen much stronger activity in the global markets and in the global trade and global demand, generally speaking, than we've had before. And theoretically, this should support your mining industry. It should support your manufacturing industry. It should help export volumes. There's stronger demand. So theoretically, the world economy is actually starting to turn in favor of miners and manufacturers. So a lot of our damage is self-inflicted. Right? A lot of what we feel is really our own doing. Just to show you the gap between domestic spending and exports in this economy, this graph really does exactly what the previous graph did, where we looked at all the industries and GDP. We take GDP again, we index it to 100 in 2007, the exact same point. Now we look at the economy from a slightly different angle. We say, okay, if you are a producer or if you're a service provider, you always have two markets available to you, don't you? You can sell into the local market, the domestic market, your so-called domestic demand, your domestic market, or if you're very fancy, gross domestic expenditure, as the Reserve Bank calls it. There it is. That is your domestic market, domestic demand. That's the green line. And you can see how that has generally outperformed your average economy, which is the black line over here. And then your other option, if you're not going to sell into the domestic market, is you can export, or you can do both. All right? And exports is really representing the global market. And here's our export performance. All right, so there's the global recession. We have a spectacular implosion, really Zimbabwean style. We reached the trough. We float there at the bottom for a while. The world economy starts to recover, and so do exports. But look at this last point. We're still below where we were. Very patchy stuff. Very, very patchy stuff. There's no strong conviction. It doesn't look anything as convincing as imports. And here's the problem, though. Our economy is mismatched, isn't it? We consume more than we produce. Okay, exports represent production. Therefore, we import more than we export. And when we talk a little bit further about the rand, bear in mind that we do not earn sufficient foreign currency through exports to pay for our imports. Therefore, we are dependent on foreigners to provide us with the dollars and the euros to pay for our imports. And whenever there is dependency on foreign capital, that foreign capital's view of the risk they take to put their money in this country becomes very important. Okay, so whether you want to ignore them or not is pretty much irrelevant, because you have to please them. You need their money to pay for your imports. Okay, so that's important to remember. We are growing in an unsustainable way. So we need to live this. And this is where the problem has been. It has underperformed. And there's no good reason in the world economy for that, because the world economy is now starting to mend. There was a good reason in 2007, and 2008, and 2009, and 2010, even in 2011 and 2012. Because even though the US started to grow, the Eurozone went into recession, and we are heavily exposed to the Eurozone. But from 2013 onwards, the weak world economy was no longer such a compelling excuse for our underperformance on the export front. And increasingly recently, the world economy is looking a lot stronger. We are, however, still getting some benefit from that stronger world economy. It's not coming through in production and exports, but it is coming through in tourist numbers. Look at this. The Western Cape, I think, had its fair share of foreign tourists. We were on a big plane this morning, and that was pretty much, from what I could hear, just German and Dutch, a little bit of French and Portuguese and Italian. but basically just foreigners, which was a relief. I didn't see anybody from Liberia or Sierra Leone. I've been very nervous about this. I've been avoiding the toilets like a plague on the plane. All right, so there you go. You can see the rise in our tourism numbers. Okay, so that at least where we've seen the benefit of the recovering in the world economy. But of course, this is South Africa, so we have a look at this and we say, oh, well, this industry is still doing well. That's unacceptable. We need to see what we can do to undermine it. And you all know what we have decided to do. We have introduced all sorts of strenuous requirements for visas coming to South Africa around traveling with your children. Okay, nonetheless, that's just a joke. You can just ignore that. But that is at least one area that is doing well. But just to show you, exporters should do better. Now, although the number for this year from the IMF, this is the IMF's forecast for global growth, although it's been revised down from April, that's mainly because the US had a very bad first quarter. They had a terrible winter. We all learned a new term called the Arctic vortex. I mean, we just called it a bad winter in the old days, but that's what they call it now. That caused all sorts of power disruptions and, property prices imploded and there was no trade and consumers didn't go out to buy and the shops closed and I don't know what else. But from April onwards, the US have come roaring back. So this number is mainly influenced by the US's winter, but you can see it's then anticipated to actually start climbing very rapidly going into 2016, where we get up to 4% growth now by 2015 and into 2016. Now, when you talk about 4% growth in global terms, that's actually strong. Anything below 4 in global terms is sort of modest. But over 4%, around 4%, now you're talking about a strong world economy. So the world is heading back to something resembling strength. The main momentum is anticipated to come from the US, as you can see there, and to carry on into 2016. The Eurozone, good news for South African exporters, because over 20% of our exports go to the Eurozone, will at least stop shrinking. Growth will still be weak, but it will at least stop shrinking. Emerging markets will do relatively well. It's still going to have faster growth, which is what you would anticipate from an emerging market or a developing economy versus a mature one. You'll see that China is anticipated to slow. This is because China is undergoing quite a significant transition. It's done all it can do in terms of its existing growth model, which, as you all know, was based on the premise that you use abundant labor. They've got, 1.3 billion little per capitas running around there, so lots of labor. And they're cheap, and you combine that with a very cheap exchange rate, an undervalued exchange rate, and you produce your sort of low margin, high volume goods, and you export it to the rest of the world. It worked very well for China for almost 2 decades, that model. And they literally became the world's factory, did they not? I mean, virtually every major firm you can think of has got a manufacturing base in China. But they exhausted that, because you can only do that as long as the rest of the world is consuming your goods. And when the global financial crisis struck and their biggest export market, the US, entered recession, they realized, well, this is a little bit of a precarious place to be. We are so dependent on exports that we have no offset if the world slows down or there's some crisis somewhere. And they now have to make this final leap. They have to really make the leap from being a developing economy, okay, an emerging market, towards being a mature or industrialized country. And to make that leap, they have to get a better combination between production and consumption. So the Chinese, which is not a democracy, they don't get to vote, and is a communist country, now has to encourage consumption. It's a fairly perverse sort of situation, if you ask me, because consumption to the communists are supposed to be revolting. Nonetheless, they've got to make that leap. Now, many countries have been there before where China is now, and I might be a little bit harsh, but Brazil was there in the 1950s and 60s. Argentina, disaster territory. Argentina was there in the 1950s and 60s. It is the hardest leap to make from a developing nation towards a mature economy. Anyway, the anticipation is, as China makes this transition and now it starts to encourage consumption, you will see something give in this process. It's a very important transition, but you will see growth slow as a result of that. And so China is slowing down a little bit. This is where we find ourselves, on the African continent. Now you can see what I mean. Much more rapid growth anticipated of Africa. And in fact, Africa is one of the few places that is just expected to continue to build momentum. And so a lot of the latest numbers for Africa has not been updated just because data is not that frequent. But you can see some of the numbers here from the last edition. Really rapid growth. And most of these countries, with of course the exception to South Africa, where IMF have reduced the growth forecast for this year from 2.3 to 1.7%. So that gives you a sense, though. We're in the right place on the right continent where our neighboring countries, which should be our trading partners, are doing exceptionally well, starting to get their act together after decades of chaos. And it's really starting to grow, unlocking wealth in those countries, developing consumer markets. We should be doing a lot better, yet we're so disappointed in terms of the rate at which we're growing. So the world economy isn't that much of an excuse anymore. But there is a little bit of a provision to this in the sense that, yes, although the world is starting to build momentum, China is slowing. And the biggest consumer of commodities up until now have been the Chinese. Our biggest producers are producers and exporters of commodities in whatever form of beneficiation, from the primary mining side all the way through to the secondary on the manufacturing side. And as you can see, because China is slowing, commodity prices have been under some pressure, including food, although food has held up better than all the other commodity prices out there. So again, the farmers really not in a bad place whatsoever. So the world economy should theoretically help South Africa. That's not why we're not growing. It's not just world growth. Government often says, because after the global financial crisis, the world economy has not been the same place it used to be. True, up until about 2013. Then the dynamics change. It's no longer the reason we're underperforming. Now, that's the one global trend I wanted to talk to. That is actually becoming a positive for us. Now, I want to talk about another global trend that holds some risk for us going forward, and that has implications for consumers. And that is the fact that global monetary policies are in fact changing. All right? And I explained to you that as a nation we are a deficit country. We import more than we export. We are a deficit country. So we run a trade deficit, and if you add our services deficit to that, you get your current account deficit. Our current account deficit is large. Now, countries can run current account deficits, provided that it is around or below 3% of GDP. Otherwise, the external financing requirement you put on your country is too excessive. Now, ours are closer to 6% of GDP, so it's double what is considered acceptable. All right? And among our emerging market peers, that would now be Russia, and it would be Brazil, and it would be Turkey, and it would be India, and Malaysia, and Indonesia. We have one of the biggest current account deficits. And we all compete for the same foreign funding. All right? And that foreign funding come to you depending on how they view the risk they're taking for putting their money in a certain country, relative to the return they get. So you can't just look at risk in isolation. You must view risk relative to return. Okay, that's very important. Now, foreign sentiments, foreign perceptions of how South Africa is shaping up, of how we're growing relative to those countries that compete for the same funds we do, other emerging markets, is the first factor that is considered when we look at risk. Now, I've already showed you South Africa has underperformed other emerging markets. So that's a negative for us in terms of attracting funds. Whether foreigners think that you are running your country in an efficient and in a morally acceptable way by international norms and standards is another factor that impacts on risk. Economic policies, how a government conducts itself through economic policies. What are they encouraging? Are they encouraging the heavy hand of the state to intervene in all sorts of industries? Are they putting foreign business off? Are they discouraging foreign investment? Are they putting pressure on their own private sector? A lot of these funds will come into the JSE, investing really in South African companies listed on the JSE. Are those companies likely to suffer because of government's economic policies? And therefore their profits are likely to suffer. And as a result, they don't look so attractive anymore, so the risk has gone up. So government's economic policies also impact on, A, the availability of funds, the amount of foreigners out there that are willing to take the risk to put their money in South Africa, and also the cost. Because if the risk has gone up, then the return you offer foreigners have to go up to keep attracting the money to finance our deficit. And ultimately, these two have a major impact on the rand and it has a major impact on interest rates. And we'll have a talk about it now.